Hello investors, if you suddenly receive lump sum amount, maybe from a bonus from your company or from matured fixed deposit or maybe from inheritance, you might wonder where to invest it. But this time you don't want to put it in FD or in gold, but lump sum amount is too small even to put it in real estate. Then the only option you left with is to put it in stock market, in equity or debt funds. Considering diversification and risk management, whenever people have a lump sum amount, these are the different way where people usually invest today. First is alternate investment funds. These are high investments meant for people with large amount of capital and the minimum investment amount required is 1 CR. Next option we have a portfolio management services. If you have at least 50 lakh rupees, you can offer for professional management for your stock investments. Now last comes the mutual funds. These are for the general public. Mutual fund offers an easier entry. You can start investing with as little as 500 or 1000 per month through systematic investment plan. Or also many people will suggest to invest 200 or 500,000 in lump sum in those portfolios. Now the issue here is the huge gap between the mutual funds, small investments and the PMS portfolio management services, that is 50 lakh plus investment. That's where the new product of SEBI comes in, that is specialized investment fund, which is middle ground. From the 1st April 2025, SEBI is launching specialized investment funds, which is an investment category that bridges the gap between mutual funds and portfolio management services, offering professional advice and expertise of experienced fund managers, along with the ability to make profit when market fall. But it is riskier too. Let's break it down and try to understand what is this SIF, what are the eligibility criteria, how these funds are structured, and what investment theme does it follow? What about taxation and if it is right for you or not? Okay, what is specialized investment fund? So SIF is a new SEBI approved investment option that allows fund manager to invest in derivatives like futures and options, meaning they can make profit even in falling market similar to hedge funds in US market. It is like buying an insurance, you use it to protect yourself from losses if the market moves against you. Let me show you a quick and simple example of how put option derivative strategy can be used as downside protection in falling market. Imagine you own 100 share of Reliance at 1250 rupees per share, but you are worried the price might drop in next 3 months. So what solution you have? You buy a put option at 1250 rupees by paying small premium. This means you have a right to sell at 1250 rupees no matter what happens. If stock falls to 1100, you still sell at 1250, that means no loss. If stock goes up at 1400 rupees, you ignore the option premium and enjoy the gains. If stock price remains same at 1250 rupees, the put expires worthless and your only loss is the premium paid. Put option acts like an insurance policy, small cost, big protection. So similarly, fund manager can use different strategy of derivative market as well in SIFs. It offers more flexibility than mutual funds while being more accessible than PMS. Let's see different type of funds under SIF. SIF allow investments across equity, debt and hybrid categories. Under equity strategy, which is stock based, we have equity long short fund, equity X top 100 long short fund and sector rotation long short fund. In equity long short fund, minimum investment in equity will be 80% and up to 25% in short selling derivatives. Daily redemption is available. In equity X top 100 long short fund, focuses on mid cap and small caps. The minimum investment in equity will be 65% and the maximum short exposure through derivative position will be 25%. Here also daily redemption of funds is available. Sector rotation long short fund. The maximum include 4 different sectors. Minimum investment in equity will be 80% and maximum short exposure will be 25%. Daily redemption is available in this as well. Debt strategies, bond based, have debt long short fund and sectoral debt long short fund. Debt long short fund covers all type of debt investments and redemption is possible once a week. Sectoral long short fund must invest in at least 2 sectors. Redemption is available once a week in this as well. Last strategy, hybrid strategies, is a stock plus bond mix, have hybrid asset allocator long short fund and hybrid long short fund. Hybrid asset allocator long short fund is a multi asset strategy redemption is available twice a week, and hybrid long short fund will have balanced risk return and redemption is twice a week. Now, who should consider SIF? SIF are meant for investors with 10 lakh plus who want professional management and have a high risk appetite. Since SIF involves derivatives, they can magnify both gains and losses, making them unsuitable for risk averse investors. Now comes the important part. Should you try a new scheme like SIF? Since SIF are new, they don't have a past performance record. Anytime you invest in new fund, you are taking a calculated risk. If your total portfolio is 1 crore plus, allocating 10 to 15 could make sense. If you have 50 lakh plus rupees, a small allocation is reasonable. But if you total have 10 to 20 lakhs, putting all of it in SIF can be riskier than mutual funds. It is best to limit exposure due to the risk involved with derivatives. Many investors are not comfortable with derivatives as they add extra risks. Whether it's an equity-based SIF or hybrid SIF, the presence of derivative increase market exposure. If you are risk averse, this may not be the right investment for you. This is just my opinion. What do you think? Let me know in the comments. Let's talk about benchmarks which will be used to compare performance of SIFs. It will be benchmarked against market indices like Sensex, Nifty and bond market indices depending on their category. Equity oriented investment strategies is compared to market indices, example BSE Sensex or NSE Nifty or BSE 100, and debt oriented investment strategy is compared against the bond market indices. Hybrid investment strategy will have a mixed benchmark based on their asset allocation. Who can launch SIFs? A SEBI registered mutual fund AMC can launch a SIF if it meets one of the following criteria. First, AMC track record. A fund house must be at least 3 years old. It should have maintained 10,000 crore AUM in the last 3 years and no regulatory violations in past 3 years. And second, fund manager's experience. The chief investment officer must have 10 plus years of experience managing 5,000 crore. The fund manager should have at least 3 years of experience handling 500 crore rupees. Now let's check taxation part. SIF follows the same tax rules as mutual funds. Long-term capital gains tax LTCG after 1 year is 12.5%. Short-term capital gains STCG tax before 1 year is 20%. Again, I am reminding that starting 1st April 2025, investors can start investing in funds into SIFs. What all SIF funds AMC will launch, we will cover again in next video. See, SIFs can be a game changer for investors looking for a structured, professionally managed investment options within 10 to 50 lakh range. They offer great flexibility and potential for higher returns but comes with higher risk due to derivative exposures. If you are new to investing, stick to mutual funds. If you have 10 lakh plus, SIF can be an option but diversify. If you have 50 lakh plus, PMS offers more customization. If you have 1 crore plus, AIF provides exclusive investment strategies. What do you think about SIF? Drop your thought in the comments. Want me to cover any other investment topic? Let me know. Don't forget to like, subscribe and stay tuned for more investment insights. See you in the next video. Keep learning and keep growing. Happy investing.